Well, you started to mention something that I would like to spend a bit more time, is the difference between market maker and STP. Because my question was about execution, and you explained the market maker keeps the trades in-house, the STP will send to the market, to the liquidity providers. So the advantage is that the STP will not have any conflict of interest with its own clients. But this is the point that I want to spend a bit more time, because what is the conflict of interest and what are the red flags that a trader should be worried about when trading with a broker, for example, as a market maker compared to an STP? And I want to go a little bit broader, meaning the deals that they can make, like a P&L deal, meaning delaying the withdrawal, meaning requotes. What are the, let's say, top 3 or top 5 red flags that you can think about for a beginner trader and even an experience, because it's not just about the spread, but it's about the whole trading environment?
Okay, I will say, let's say, okay, the definition of the market maker and the STP, as you said, is that the market maker will make the first sense once the clients start to lose money.
Yep.
Okay. And I will come back another story about this as well. And let's say what we call a STP broker, which is a straight-through processing broker, is that is connected, let's say, with at least more than one liquidity provider, best case scenario, maybe 3, 4, 5, whatever. They aggregate the price in order to have the best price, and they give it to you. And they put a markup on top of that, and this is their income. Yep. So your performance in trading will not affect the income of the broker. There are other risk management, which I will not, but let's keep it simple. So if we take the trading activity as a client, in individual clients, when he loses, this is the profit of the market maker broker.
Yep.
And for the STP broker is the volume. More it does volume, more the broker makes money, independently of the losses or the profit. Okay? So this, let's make it clear. Now you ask me a question, let's say the
red flags.
The red flags. The red flags, for example, you have red flags like if we know I think that most of our auditors are using MT4. Is, for example, you cannot put an order at, you need to have a minimum deviation of the market price in the ordering, let's say. This, it's, for example, you are a market maker, but again, it's not something wrong for me. There are good market makers in the industry, and I will not say no. But just to make some, let's say, to understand if it's more STP or market maker. Then you have, let's say, for me, as I said before, one of the red flags is the latency. I mean, if you have to count 1, 2, 3 in order to be executed, just make sure that your internet line is okay. But if the internet line is fine, then it's not acceptable. Then you have the requote. I mean, the requote should never exist. At least in Forex, where it's a massive liquidity market. I will not speak about stocks and let's say but when there is not liquid, but a massive liquid market, there is no requote. I mean, I never had a requote in my life almost. So,
can you explain why? Because we have a lot of beginners maybe who are watching. So I know you have a lot of experience, but you're going straight to the point. STP. Okay. Like in terms of execution, why the execution will be slower and why the execution might have requote. So why the 1, 2, 3? Okay. Why the requote? Where is this order going to make it have a requote?
So in order, let's say in terms of, let's call it in terms of flow of the orders, I'm talking about when you have a requote basically, is that when the clients trade, let's say push on the button,